Our next guest says that the narrative ping pong about the type of economic landing that market analysts are expecting is far from over. Let's bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and President of Queens College at Cambridge University. I was wondering whether it was over. I read a piece that said you can expect stocks to keep getting a pretty good bid, Mohamed, as people come to the conclusion that the soft landing dream is actually playing out. And it's always been nothing but a dream in the past. I don't know if they've ever really done it. People are starting to think that it in fact, is a reality. Do you doubt that?
So certainly that's where the market is going. The market believes that because we're heading for a soft landing, we will see not only the end of the hiking cycle, that's done, but we're also going to see aggressive cuts next year, and that will be consistent with growth not suffering in any material way. So that's where the market is. And I'm saying this not just on what's happened in the Treasury complex, but look at corporate spreads, look at other indications. That's where they are. I think the market is absolutely correct in pricing in that the Fed is done. Beyond that, however, there are significant uncertainties, Joe. And I think that what's priced in right now for cuts next year is probably too aggressive.
Right. So, but we may not see another hike.
We should not see another hike. I'd put it stronger. We should not see another hike. The Fed should, at this point, wait to see what the lagged effects are of what it's done. And also, importantly, we need to understand better two things that we don't have a handle on. What is the new neutral level of interest rate? And what are the disinflationary dynamics in the service sector? There's big uncertainties about both these issues, uncertainties that the markets has brushed aside, but I think the Fed is aware of those uncertainties.
The interest rate environment and the absolute price levels are still not great for consumers, Mohamed. How long can we count on? I mean, we may be seeing a little softness, but still hanging in there. What about 2024?
So it depends what you're consuming. The Journal has a nice piece today that shows you that the most popular gifts that we tend to give at Christmas time, their prices are actually lower than they were a year ago. So there's a small segment of the goods sector that has not just had disinflation, it has had negative inflation. That's the good news. But the service sector, us traveling for Thanksgiving, us doing all the other stuff we like to do, eating out, etc., that's still subject to high inflation. It just shows you the dynamics are very different between the goods sector and the service sector.
I was going to ask you whether I should still send you a Zach Wilson jersey. I think I can get those fairly cheap, Mohamed.
Yeah, Joe, I don't know what to say. I mean, I don't know what to say. Well, he was benched, so that should be a message to him. But what I worry about most, Joe, if you want to go towards the Jets, is that our incredible defense is going to start being really fragile because they can't stay on the field that long. We need our offense to produce, and our offense hasn't produced.
I immediately when they put when they replaced him, he was getting rid of the ball much more quickly. That's Zach's problem. I'm telling you, that's his problem. He's like, I don't know. It's like throw it or do something, right? Isn't that it? Isn't that the problem? It's like he's worried about. Anyway, but so Mohamed, next year.
But before we leave that, I don't want to leave people with that impression because then they will blame the offensive line. I think he just has to come up the learning curve of getting a better sense of who's open, who's not open. And there's nothing wrong with throwing it away. Most of our mistakes come from the fact that he doesn't throw it away.
I mean, people over in the UK where you're a Scots, you're going to say, why aren't you talking about round ball football? You're probably making people mad, Mohamed. How about corporate earnings next year in this weird environment that you described? We're counting on a gain in the levels of valuation we see right now imply what type of earnings gain. I would say at least 10, 12% for next year. Will we get it?
I don't think we'll get it on average. I think we will get it for a few. In fact, the big theme for next year is going to be a lot more dispersion, even more than what we've seen this year. And we're going to be talking about a handful of stocks that are having a big influence on the averages, but that is going to be a handful. This is not going to be an environment of lifting all boats. It's only going to lift the boats that have the following characteristics. They are cash rich, balance sheet strong, because I don't think interest rates are coming down as fast as the markets assume. Second, they are riding a massive secular wave. And third, they have good management. And if you apply those criteria, you really end up with quite a small set of names going forward.